I want to talk to you about something I consider extremely important: how to start investing when you have little money. Many people believe they need to be rich to invest, but I can assure you that this is one of the biggest fallacies in the financial world. In fact, some of my best investments were made when I had very little capital, and the principles I learned back then remain the basis of everything I do to this day. When I was 6 years old, I bought my first six-pack of Coca-Cola for 25 cents and sold each bottle for 5 cents, making a profit of 5 cents. It wasn't much money, but I learned something valuable. You don't need large sums to start. What you need is solid principles, patience, and a genuine desire to learn. At 11 years old, I bought my first stocks, 3 shares of City Service Preferred, for $38 each. I worked as a newspaper delivery boy, selling over 500 newspapers a day to save that money. Every penny counted, and I understood the value of every dollar I earned. The first thing I need to say is that investing with little money doesn't mean you're at a permanent disadvantage. In fact, starting small can be a blessing in disguise. When you have limited resources, you're forced to think much more carefully about every decision. You can't afford to make costly mistakes, so you naturally develop a discipline that many wealthy investors never acquire. This discipline is one of the most valuable assets anyone can have in the world of investing. Let me be blunt about something. It doesn't matter how much money you have right now. What matters is what you do with it and how you think about money. I've met people who made millions and lost it all because they didn't understand the basic principles of investing. I've also met people who started with almost nothing and built considerable fortunes because they consistently followed the right principles. The difference wasn't in the starting point, but in the mindset and habits they developed. The first fundamental principle I want to share is this: live below your means. This may sound too simple, but it's absolutely critical. If you spend everything you earn, you'll never have money left to invest. And if you spend more than you earn, you're digging a hole that will become increasingly difficult to get out of. I still live in the same house I bought in 1958 for $31,500. It's not because I'm stingy, but because I understand that a bigger or more expensive house wouldn't make me happier. What makes me happy is financial freedom and the ability to do what I love every day. When you're starting with little money, every dollar saved is a dollar that can work for you. Think of it like a small army. In the beginning, you only have a few soldiers, but if you take good care of them and keep adding more soldiers to your army, eventually you'll have a powerful force. But if you keep sending your soldiers away by spending money on unnecessary things, your army will never grow. Many people ask me, Warren, how much should I save? My answer is always the same: save as much as you can without sacrificing your health or important relationships. For some, that might be 5% of income. For others, it might be 20 or 30%. The important thing is to start now, no matter how small the amount. If you can save just 50 reais a month, start with that. The habit of saving is more important initially than the specific amount. Now, let's talk about where to put the money you're saving. Before investing in anything, you need to have an emergency fund. This is non-negotiable. An emergency fund is money you keep in a safe and easily accessible account to cover unexpected expenses. How much do you need? Ideally, 3 to 6 months of your essential expenses. If you're starting out, work towards having at least 1,000 reais saved as an initial buffer. This money won't yield much, but that's not the goal. The goal is to protect you from having to sell investments during bad times or going into debt when something unexpected happens. Once you have your emergency fund established, we can talk about investing for real. And here's something many people don't understand. When you have little money, the best investment you can make is in yourself. Buy books, take courses, develop skills that increase your ability to make money. When I was young, I spent a lot of time reading company annual reports and studying investments. It cost me almost nothing, just my time, but the return on that investment was infinite. I read Benjamin Graham's The Intelligent Investor when I was 19, and that book changed my life. It only cost a few dollars, but it was worth millions to me in terms of what I learned. Learning about investing doesn't have to be expensive. There are public libraries full of excellent books on finance and investing. There are free resources online. You can read annual reports of publicly traded companies for free. The information is available. What many people lack is the willingness to dedicate time to learning. If you spend 1 hour a day studying investing, in a year you will have 365 hours of education. That's more than many university courses offer, and it can cost practically nothing. When you finally start investing in financial assets, the most important principle is this: never invest in something you don't understand. This seems obvious, but you would be surprised how many people violate this rule. They hear a hot tip from a friend or read about some trendy stock and invest without really understanding the business. That's not investing, it's speculating. And speculating with money you can barely afford to lose is a recipe for disaster. For investors starting with little money, my main recommendation is to focus on low-cost index funds. An index fund is a collection of many different stocks that replicates a specific market index. In Brazil, you can invest in funds that track the Ibovespa, for example. In the United States, I always recommend funds that follow the S&P 500. The beauty of an index fund is that you get instant diversification. Instead of putting all your money into one or two companies, you're buying small pieces of hundreds of different companies. Why index funds? First, they have very low fees. The less you pay in fees, the more money works for you. If you invest in a fund with a 1% annual fee versus an index fund with a 0.1% annual fee, over 30 years, that difference can cost you hundreds of thousands of reais and lost returns. Second, index funds beat most professional managers in the long run. This may seem counterintuitive, but it's true. Most actively managed funds, after collecting their fees, fail to consistently outperform the market. When you invest in an index fund, you're basically betting that capitalism will continue to work. You're betting that companies, on average, will continue to generate profits and grow over time. Historically, this has been a very good bet. The stock market in the United States has returned approximately 9 to 10% per year on average over the last 100 years. Of course, some years are bad and some are excellent, but in the long run, the trend has been consistently upward. Now, let me be clear about something important. Investing in the stock market requires patience. If you need your money in the next 2 or 3 years, the stock market is not the right place for it. The market can be extremely volatile in the short term. It can fall 20, 30, or even 50% in a matter of months. But if you have a time horizon of 10, 20, or 30 years, these drops don't matter. In fact, they are opportunities. When the market falls, you are buying at a lower price, which means your money goes further. One of the best strategies for those starting with little money is what we call regular investment or dollar cost averaging. This means you invest a fixed amount at regular intervals, regardless of what the market is doing. For example, you decide to invest 200 reais every month in an index fund. Some months, when the market is high, you will buy fewer shares. Other months, when the market is low, you will buy more shares. Over time, this smooths out the highs and lows and removes the emotion from the equation. Emotion is the investor's greatest enemy. When the market is rising and everyone is making money, it's easy to get greedy and want to invest more. When the market is falling and the news is all bad, it's natural to feel fear and want to sell everything. But these emotions lead you to do the exact opposite of what you should do: buy high and sell low. A regular investment strategy helps you avoid these emotional traps because you follow a plan, not your emotions. Another advantage of starting with little money is that you have time on your side. And time is the most powerful ingredient in the investment formula. There's a concept called compound interest that Albert Einstein supposedly called the eighth wonder of the world. Compound interest means you earn returns not only on your initial investment, but also on the returns you've already accumulated. It's like a snowball rolling downhill, getting bigger and bigger. Let me give you a concrete example. Suppose you start investing 1,000 reais per month at age 25. If you achieve an average return of 9% per year, which is reasonable for a long-term stock index fund, by age 65 you will have approximately 2,200,000 reais. Of that total, you will have contributed 480,000 reais from your own pocket. The rest, more than 1,700,000 reais, comes from compound interest. That's the power of time working in your favor. But here's something even more impressive. If you waited until age 35 to start investing those same 1,000 reais per month, by age 65 you would have about 900,000 reais. You contributed 360,000 reais, so you earned about 540,000 in returns. That's still good, but it's less than half of what you would have if you had started 10 years earlier. Those extra 10 years of compounding make a huge difference. That's why I always say, start now, even if it's with little. The best time to plant a tree was 20 years ago. The second best time is today. When you're investing with limited resources, it's crucial to minimize costs. Every dollar you pay in fees and commissions is a dollar less growing for you. Look for brokers with low or zero fees. Avoid funds with high management fees. Don't constantly buy and sell because each transaction usually has a cost. The buy and hold strategy is not only more effective from a return standpoint, but also cheaper. Many people also ask me about investing in individual stocks. My opinion is that for most people, especially those starting with little money, picking individual stocks is not the best strategy. Why? Because doing it correctly requires a lot of time, knowledge, and analysis. You need to read financial statements, understand the industry, evaluate the company's management, and much more. It's almost a full-time job. Unless you're willing to dedicate that time and have an aptitude for it, it's better to leave diversification and selection to an index fund. That said, if you really want to learn how to analyze individual companies, do it with a small percentage of your money, maybe 10 or 20% of your portfolio. Use this as a learning lab. Choose companies that you understand that make products or services that you use and appreciate. Study these companies deeply. Read their annual reports. Understand their numbers. And only invest if you truly understand the business and believe you are buying at a reasonable price. One of my favorite principles is the concept of margin of safety. This comes from my mentor, Benjamin Graham. The idea is simple. Only buy something when the price is significantly below what you believe to be its true value. If you think a company is worth 100 reais per share, don't buy at 95. Wait until you're selling for 70 or 60. This margin of safety protects you from errors in your judgment or unforeseen events. When you have a margin of safety, you don't need to be exactly right, just approximately right. Another area I can't fail to mention is the importance of avoiding bad debt. There is a difference between good debt and bad debt. Good debt is debt that helps you build wealth, such as an educational loan that increases your earning capacity or a mortgage on a house you can comfortably afford. Bad debt is debt used to buy things that lose value or that you don't really need, such as expensive clothes on a credit card or a car far beyond your means. Interest rates on credit card debt are absurd, often in the range of 150 to 300% per year in Brazil or 20 to 30% in the United States. If you are carrying a balance on your credit card and paying that interest, there is no investment in the world that can consistently outperform that. Paying off credit card debt is technically a guaranteed return equal to the interest rate you are paying. This makes it one of the best investments you can make. So if you have credit card debt, my advice is this: build your basic emergency fund of 1,000 reais first, then attack that debt with everything you can. Make minimum payments on all your debts, but put any extra money toward the debt with the highest interest rate. Once you're debt-free, you can redirect all that money that was going toward interest payments to investments. It will be like receiving a substantial raise. Speaking of increases, whenever your income increases, whether through a salary raise, a promotion, or extra work, resist the temptation to increase your lifestyle proportionally. This is what I call lifestyle inflation, and it's a trap that ensnares many people. If you're living comfortably on 3,000 reais a month and receive a raise that brings your income to 4,000 reais, don't immediately start spending 4,000 a month. Continue living on 3,000 and invest the extra 1,000. In this way, each raise significantly accelerates your journey to financial independence. Financial independence, by the way, should be everyone's goal. What do I mean by financial independence? It means having enough money invested so that the returns on your investments can cover your living expenses without you needing to work. I'm not saying you should stop working when you achieve this. I love what I do and plan to continue doing it as long as I can, but there's a huge psychological difference between needing to work and choosing to work. Financial independence gives you freedom, options, and peace of mind. To achieve financial independence, you need two things: spend less than you earn and invest the difference wisely. It really is that simple, although not necessarily easy. The hard part is consistent discipline and patience over many years. But I can guarantee it's worth it. The sense of security and freedom that comes from having financial resources is invaluable. Now, let me address something important. Don't compare your journey to others. We live in an age of social media where everyone seems to be living perfect lives, taking expensive trips and buying extravagant things. But this is often an illusion. Many of these people are drowning in debt or not building any real wealth. They are trading future security for present gratification. Don't fall into that trap. Don't spend money you don't have to impress people you don't even like with things you don't need. One of the best pieces of advice I can give is to surround yourself with like-minded people about money. If all your friends are constantly spending money on expensive things and pressuring you to do the same, it will be much harder to maintain your financial discipline. But if you have friends who value saving and investing, who get excited to talk about their financial goals, it makes everything much easier. Charlie Munger, my longtime partner, used to say that you become like the people you spend the most time with. Choose these people wisely. I also want to talk about patience in the context of investing. In today's world, everyone wants instant results. People look for stocks that will double in a week or cryptocurrencies that will make them rich overnight. That's not investing, that's gambling. And while a few people get lucky with these bets, the vast majority lose money. True wealth is built slowly over time through consistent and prudent decisions. I like to think about investing like this. If you're not willing to own a stock for 10 years, don't think about owning it for 10 minutes. When you buy shares in a company, you're becoming the owner of a small part of that business. You should think about it the same way you would think about buying an entire company or a stake in a local business. Would you make that purchase expecting to sell tomorrow? Of course not. You would do it because you believe in the long-term value of that business. Let me share a story. During the 2008 financial crisis, many people panicked and sold their investments when the market crashed. The U.S. stock market fell more than 50% from its peak. It was terrifying. But I knew this was an opportunity, not a crisis. I wrote an article for the New York Times in October 2008, at the height of the panic, saying that I was buying American stocks. Many people thought I was crazy, but I understood that large companies were being sold at absurdly low prices because of fear. If you had invested in the market at that moment of maximum pessimism, you would have multiplied your money several times over in the following years. The market not only recovered, but reached new records. People who sold in panic locked in their losses and missed out on the entire subsequent recovery. Those who held onto their investments, or better yet, invested more during the crisis, were handsomely rewarded. The lesson is this: be greedy when others are afraid, and be afraid when others are greedy. Sure, it's easy to say that in hindsight. Right now, when the news is all bad and it feels like the world is ending, staying calm is extremely difficult. That's why having a plan before a crisis happens is so important. Decide now, while the market is calm, what your strategy will be if the market drops 20, 30, or 50%. If you decide in advance that you will continue investing your regular monthly amount, no matter what happens, it will be much easier to stick to that plan when things get tough. Another important thing, don't try to predict the market or time your purchases and sales based on what you think the market will do. Nobody can consistently predict the market, not me nor any other investor. There are literally thousands of highly educated and well-paid professionals trying to do this every day, and most fail. If they can, why do you think you can? The good news is that you don't need to predict the market to succeed as an investor. You just need to consistently follow sound principles. When I evaluate a company, I ask a few simple questions. Is the business easy to understand? Does the company have a consistent operational history? Does it have good long-term prospects? Is management capable and honest? Does the company have a sustainable competitive advantage, what I call an economic moat? And finally, is it available at a reasonable price? If the answer to all these questions is yes, it may be a good investment. An economic moat is something that protects the company from competition. It can be a strong brand like Coca-Cola. It can be a cost advantage like Walmart had in its heyday. It could be network effects like Facebook. It could be high switching costs that keep customers locked in. Companies with wide economic moats can maintain their competitive advantages for decades, generating excellent returns for their shareholders over time. But again, for most people starting with little money, trying to find these individual companies isn't necessary. A good index fund will give you exposure to many excellent companies with economic moats, along with many average companies. And the net result over time has been very good. The simplicity of this approach is one of its greatest virtues. I also want to talk about the importance of continuing to learn. The world of business and investing is always changing. New industries emerge, old industries decline, disruptive technologies emerge. You need to keep learning. to stay relevant. I read about 500 pages a day, mostly company annual reports and business newspapers. You probably don't need to read that much, but dedicating at least 30 minutes to an hour a day to learning about investing in business will make a huge difference over time. And don't forget to learn from your mistakes. Everyone makes mistakes, and I've certainly made many over the years. The important thing is to recognize your mistakes, understand why you made them, and make adjustments so you don't repeat them. I keep a record of my investment decisions and periodically review both my successes and my failures. I often learn more from my failures than from my successes. There's also a character issue that's fundamental to success in investing. You need to be honest with yourself. If you made a mistake, admit it. Don't try to justify it or blame someone else or the market. Take responsibility. You also need to be patient, disciplined, and able to delay gratification. These character qualities are more important than pure intelligence when it comes to investing successfully. One of the questions I get asked most often is when to sell an investment. My general answer is rarely. If you chose well from the start, buying quality companies or a good index fund, there's no reason to sell just because the price has gone up. You should only sell if the original investment thesis is no longer valid. For a sole proprietorship, this could mean that the business has fundamentally deteriorated, management has changed for the worse, or you found a significantly better opportunity. For an index fund, honestly, there's rarely a good reason to sell unless you need the money. Taxes are another important consideration. Every time you sell an investment at a profit, you generally have to pay taxes on those gains. In Brazil, there's a capital gains tax. In the United States as well. If you buy and hold, you defer those taxes until you eventually sell, allowing more of your money to continue compounding. This is another reason why the buy and hold strategy is so powerful. I also want to briefly address other asset classes besides stocks. Real estate can be a good investment, but it requires significant capital to start, as well as ongoing maintenance and involvement. For someone starting with little money, real estate is generally not the best first choice. Bonds and fixed income are more conservative than stocks, but they also offer lower returns in the long term. They have their place in a portfolio, especially as you get older and need more stability. But for young investors starting out, a heavy allocation to stocks through index funds generally makes more sense. As for cryptocurrencies, gold and other alternatives, I am skeptical. I invest in productive businesses that generate real value. Gold just sits there. It doesn't produce anything. Cryptocurrencies are speculative and don't generate cash flow. This doesn't mean that these assets can't go up in price, but going up in price is different from creating real value. I prefer to own companies that make products that people need and want, employ people, and generate increasing profits over time. As you accumulate more money over the years, you can begin to diversify more and consider other opportunities. But in the beginning, with limited resources, simplicity is your friend. Focus is your friend. A good low-cost index fund, regular and automatic contributions, patience, and time are all you really need. Let me conclude with this. Starting with little money is not a disadvantage if you have the right attitudes and habits. In fact, it can be an advantage because you develop discipline and learn to think carefully about every financial decision. Capitalism is a wonderful machine for creating wealth, and you can participate in that machine no matter how much money you have today. All you need to do is start, be consistent, and give time for compounding to do its magic. Don't be discouraged by how long it seems to take. 30 or 40 years may seem like an eternity when you're starting out, but those years will pass anyway. The question is, where do you want to be financially when they're gone? If you start today and follow the principles I've shared, I guarantee you'll be in a much better place. And the journey itself, the process of learning about investing and watching your wealth grow over time, is rewarding and educational. I remember how I felt when I saw my investments reach the first $1 million. It was exciting. But you know what was even more exciting? The principles and discipline that got me there, because I knew those same principles would continue to work, and they did. They will work for you too if you give them time and consistency. So start today. Don't wait until you have more money, until you understand everything perfectly, until the right time. The right time is now. Even if it's just 100 reais a month, start. Your future self will thank you for taking that first step today. Good luck, and remember, in investing as in life, what counts is not where you start, but the direction you are going and your consistency in staying the course.